that most of the debt funds had a tough time in the past. In fact, most of them failed to beat inflation. Further, uncertainties around interest rates, inflation, and other global events continue to exist. On top of that, there are new products like P2P lending, NCDs, which are gaining grounds recently. So now the question arises, if debt funds still make sense, and if yes, what strategy you should follow to deal with them, to deal with rising inflation and interest rate? So to answer these pertinent questions, we have two industry stalwarts today. G. Pradeep Kumar, CEO Union Mutual Fund, and Parijat Agarwal, Head Fixed Income at Union Mutual Fund. Welcome, Pradeep and Parijat.
Thank you, Nishant. Thank you for this opportunity to have this conversation.
Great.
Thank you. Thank you, Nishant.
Thank you. Thank you. So friends, I must tell you that while Pradeep has over 3 decades of experience, Parijat brings with him over 26 years of experience. So I can say that we will going to have a power-packed session today. Great. So Pradeep, I'll start this webinar with you. So Pradeep, as you understand that over the last 3 years, majority of debt funds have not performed well. In fact, most of them have delivered less than inflation returns. So hence many distributors have shifted their focus to other products like P2P lending and NCDs, invoice discounting, and so on. So in such a scenario, why do you think that debt funds still deserves a place in their client's portfolio?
I think that's one of the most relevant question in the minds of distributors and investors today, Nishant. It's absolutely true that the returns from debt funds over the last 2-3 years have not been up to the expectation of investors. And I would say that is precisely the reason you should actually start looking at debt funds now. Okay. Debt funds and debt market in general, as you know, moves in cycles. You catch a cycle at the right stage, you make significant amount of returns. And if you're in the wrong part of the cycle, yeah, the returns can be very, very ordinary. Now, we had a situation where in the beginning of the pandemic, interest rates dropped significantly because of central government action, abundant liquidity, etc. And from there, in a relatively short time, we have seen interest rates picking up. You know, from a sub-6 levels, now you have 10-year, GSEC rates moving at about, say, 7.4 to 7.45 range. Now, as everyone knows, when interest rates move up, the price of fixed income securities go down. Now, this is what has caused the low returns, or in some cases, even losses in debt funds in recent past. Okay, but at the same time, we now believe that we are reaching, or maybe we are already at somewhere close to the peak of this cycle. And we see a very good opportunity where over the next, say, 2 to 3 years, interest rate cycle will reverse. And when it reverses, people will actually make good returns. While it is human tendency to look at only the immediate past, the recent results, and, form impressions, if we go back in time, and the experienced investors would remember that when you were on the right part of the interest rate cycle, the returns were really extremely good. Now, we believe that over the next 3 years, there is a good probability of catching that interest rate cycle at the right stage. And combined with that, today we must realize that the accrual levels are also very good. You have 10-year, like I said, at 7.4%. And, when you compare it with many of the other fixed income products, it's fairly good.
So there's a great chance that debt fund will fairly outperform other products like P2P and other in the markets currently.
Yes, absolutely. And what we must also remember, Nishant, is that in the last 3 years or 2 years plus, when interest rates fell significantly, many people who were investors in debt funds or in debt instruments in general took a hit because they were dependent on accrual income, and accruals were fairly low from fixed income instruments. And this forced many people to go for higher risk instruments, right? Because they definitely needed that extra accrual, and some of them actually were forced to chase yields and take higher risk. Now we believe that there is a great opportunity for people to make good income and good capital gains from fixed income instruments, and especially from Government of India securities with low risk.
Great. So Parijat, my next question is to you is that, so Parijat, as we know that uncertainties around interest rate, inflation and other global events continue to exist. So let me start by asking a most common question in everyone's mind. So what is your near-term outlook on the debt market?
Thanks, Nishan. To add to earlier what Pradeep had said, see, whatever we saw in the last 2-3 years was one-off event. This pandemic we had not faced. This unprecedented, decadal high inflation we had not seen. In fact, even the US at 9.1%, where for so many decades it has not reached there. So these were the some factors which led the rates to go up, and obviously your mark-to-market losses happened in your investment. Besides that, looking at today, what are the drivers that are going to keep the interest rates going up? The first and foremost is definitely inflation, and because all these central banks across the globe are inflation targeting regulators. So inflation, if you have seen in the near term, they have started to, I would say, stabilize, or the momentum is reducing. I wouldn't say that it has peaked or it is going to reverse next month, but yes, the momentum is slowing. We have seen commodity prices have started to come down. Even the oil prices, we have seen that after touching 122, it is back to 100 to 105 levels. And this is the level at which the RBI has also taken into their calculations. And edible oils, they have started to come down and expected to come down further. So supply sides have started to ease off because China reopened. A lot of supply concerns were from China because of the lockdowns there. So these things have started to happen. So as and when we start seeing that inflation starts to taper off, we believe that interest rates tightening by the central banks would start to end. Are we near that? It appears so. In our assessment, it looks like so, because in the first 2 quarters, we could again see the inflation in domestic market remaining at around 7%. But as we move towards the 4th quarter of this financial year, it would be closer to 6%. That is where, lower than the RBI's threshold, the upper threshold, 6%. So in the near term, yes, we can see some upticks in the interest rates. But as we go along over a period of time, in the near term, near to medium term, we could see the yield starts towards their southward journey. So that's why Pradeep also highlighted that it is now looking that rates are picking out. That's what it is.
So Parijat, what could be the tentative movement of yield curve in the 3-year period?
Yeah, so in a 3-year period, if you look at today's the yield curve, RBI has already tightened by 40, 40 and 50. If you take the first 40 bits from 335 to 375, 130 basis they have already tightened. It appears that looking at the inflation trajectory and the external sector, because rupee has also touched 80. So RBI may continue on this path for some more time till where they feel that sacrifice ratio. What is that? How much they need to sacrifice growth to control inflation. So when there it starts to balance out, they would stop. So from that angle, it appears that rates could still go up, but not as much as it has been in the past 3 months, which we have seen. So yes, the 7-year 740 may go to 775 or 8. But the pertinent question to ask is, can it sustain at those levels? So in the interim period, one can see any levels. Right. But the question to ask is, can it sustain at those elevated levels? any elevated levels is not good for the economy. Our project shorts are not viable. So
Right.
from that angle, one can say that yes, these are fairly good levels. And even if the rates go up, they are expected to trend downwards going forward because inflation is expected to trend towards 4% in next financial year.
Great. So Pradeep, my next question to you is that so you know that many distributors recommend SIPs in equity fund, but they recommend lump sum in debt funds largely. So what do you think that distributors should recommend SIPs in debt funds as well?
I think SIP in debt fund is definitely an idea worth considering. Of course, it depends on the goals of the investor and the kind of cash flows that she has. See, for example, if you have a goal to be met in the next 2 years, right? An equity SIP may not be appropriate. I would say it's not at all appropriate for you because it's quite possible that in 2 years' time you may lose money in equity. Who knows? But for such investors, an SIP in a debt fund, particularly if your idea is to save a certain part of your monthly income, SIP in a debt fund would be most appropriate, right? And the other thing to keep in mind is that the concept of rupee cost averaging may work quite beautifully for debt funds also, because it is not that debt funds are not volatile. There are times when debt market can be more volatile than the equity market, right?
Yeah.
We have seen that in the last 1 year. There are times when the debt markets also have been volatile. So I think there is definitely merit in having SIPs in debt funds also. In a fund like the gilt fund, SIP would make sense, but it ultimately depends on what is the horizon that the investor has and also what kind of cash flows they have.
Great. Pari, I would like to understand that why do you think that debt funds will make a strong comeback from here? And which categories of debt funds should MFDs look at?
See, debt funds are definitely, going to be a very, very good investment avenue for investors. Because the yields are already at elevated levels, like a government of India is at 740. If you add a AAA rated PSUs, which run at 20 to 30 basis or STLs, they are at a spread of 30 to 40 basis, so 780. So these are fairly good levels. And why it has come so? Because government is borrowing heavily. So obviously, our fiscal deficit is close to 6.8 expected this financial year. So when government is borrowing so heavily, you obviously, the private investment is crowded. So even if you look at your FD rates, they are still at 570 levels, or I think some banks are giving 6% for 2 to 3 years. Even your small savings rate is 7.1. So the levels are very, very attractive. So both, because you are getting higher accrual compared to the other savings investment avenues. Plus, when the interest rate cycles turns around, obviously, we are seeing that the rates would go down over a period of time, maybe in the next 2 3 years. You tend to gain from mark-to-market gains also, because the instruments would be valued and the M2M gains would be there. So your accrual plus M2M gain could definitely give you much better outcome compared to your various other products. The other asset classes, I would say, like your even gold, or further, where your risk appetite is not for equity. So from that perspective, debt funds are very, very rightly placed as of today. And the one thing that why rates may, one can ask, the rates may go down again at say 4%. Yes, it may go down. But what we are seeing is that the period of easy money is disappearing. So even if you have seen that US Fed is reducing their balance sheet size by 9 trillion over a period of 3 years, RBI has gone back to their 1.5% of NDTL liquidity. So rates are expected to remain on the higher end compared to what we have seen in the past or during the pandemic. So from that perspective, it is a very good attractive levels to invest. So what are the products where one can invest? Obviously depends upon your cash flows, risk profile. But yes, it makes more sense to be placed along the yield curve. So for the shorter end, you can say liquid or money market depending upon, because they definitely give you much better return than your savings account. A corporate bond fund, where short to medium, because generally 2.5 years of duration people run. So that is a good basket with safety. Guild fund, yes, you can think like it is a replacement of your FD with a better outcome today. So these chances come very not frequently.
Right.
So these are the times because government is borrowing heavily. So that's why you have got this opportunity as of now. So one can think of replacing with that. And if you are a very savvy investor, long end funds are there for you.
So Pradeep, so Pari just spoke about guild funds, and Union Mutual Fund has recently launched Union Guild Fund. But value research data shows that in the past, this category has delivered 5% return in 3 to 5 years time period, so which is less than inflation. So considering this coupled with heightened interest rate risk, why are you so bullish on guild funds?
Again, I go back to my opening statement. I think the fact that they have not delivered great returns in the recent past is what makes them attractive now, because it moves in cycles, and we believe we are sort of placed at a very good stage in the cycle. Nobody can claim that this is a perfect time. We don't know that. You know that only with hindsight. But we believe this is a good enough time to really start riding that wave. Okay, so as Parijat explained, we expect that elevated interest rate levels cannot be sustained. They have to start coming down, and there are a number of reasons why we believe they will come down. Okay, commodity prices have already started coming down, and obviously it's not a desirable situation to have high interest rates, and that will lead to, so on top of the existing accrual levels, which as we explained, is primarily on account of excessive government borrowing. Then you have the possibility of the interest rate cycle changing, and as a result, standing to gain, from mark-to-market appreciation. And the third factor, which is not often, widely propagated in our view, is the taxation. See, if you hold this for more than 3 years, you stand to gain from the long-term capital gains tax post-indexation. And particularly for people who are in the higher income brackets, it makes it a very, very attractive proposition. So if you, for example, make say 7% post-tax in a fund like this, that is better than, as good as getting more than 10% pre-tax in another instrument for somebody in the higher tax bracket, right? So which is what we believe makes this product quite attractive for most investors who are, who can allocate for debt funds, and especially guild funds like this. And especially for people in the higher tax brackets, the benefit of taxation will be higher.
Okay.
And compared to any other debt fund category, guild funds naturally carry the lowest form of credit risk.
Okay. But Pradeep, many MFDs now prefer target maturity funds for the long-term allocation. So why do you think it still makes sense for them to look at guild funds more actively?
I think, it's not one or the other. It is about what is more suitable for a particular investor. So target maturity funds are a good product. So we have nothing against that. The only thing to keep in mind is that these are open-ended funds, and you need to be mindful about the underlying liquidity. Now, if there are target maturity funds which carry relatively illiquid instruments, I think distributors and investors need to be a lot more cautious. The advantage of a gilt fund like this is that it carries papers that carry a higher level of liquidity. So when you run open-ended funds, it is very important to maintain a higher level of liquidity in the portfolio. So on that side, I think gilt funds score better.
Okay. So Pari, you want to add something?
Yeah. See, this target maturity funds became very popular, some time back, because that time, if you realize that yield curve was very steep, from 1 year to 6 7 years, the term spread used to be very very elevated because RBI had kept the repo rate at 4% and reverse repo at 335. So obviously people came with around 6 year 7 year kind of maturity papers. Now, as Pradeep highlighted, there is a problem of illiquidity in those instruments, even if I hold STLs or G-SECs, because I have to replicate one index. So some papers may not be liquid at all points of time in the debt market. But in the gilt fund, what happens is that now the levels of whatever the yield was of 7 years is now of 3 years. So with a lower risk in the portfolio, higher liquidity, these funds, I would say at this point, are better placed from risk return perspective.
Great. So before moving ahead, I would like to take some audience questions so that we can cover their perspective as well. So the Tanmay Paul, so his question, he wants to ask that still the inflation is not under control, and he can see that inflation, interest rate will going to, move upwards in the coming RBI meet. So what strategy he should follow in terms of creating debt portfolio to shield his client's portfolio from interest rate risk particularly?
See, as I mentioned earlier, that RBI would continue to hike the policy rates. Inflation is still not within the upper threshold because all the monetary policy actions comes with a lag. So whatever actions RBI is taking would start impacting after a certain period of time. So maybe 6 months, a year's time. So the trajectory is clear. That's what I have been highlighting. I know that these actions by RBI of tightening liquidity and raising rates would definitely work in bringing the inflation below 6%. Now RBI may continue to raise rates. As I mentioned, there is a point where they calculate that how much more they need to do so that growth is not impacted substantially. So for example, today the repo rate is set 490, even if RBI takes it by 6. Now the question is, will it the 10-year similarly go by 100 basis? Typically what happens is that because some demand destruction happens, so yield curve starts to become flatter. So from that angle, 3 to 5 year kind of a bucket becomes very, very attractive from risk reward perspective. So for investors to invest in such a product where risk reward is higher, because if you remain at very low end, you will miss out the higher accrual plus M2M gain advantages. And if you are at extremely long end, yes, your gains would be very, very high, both accrual and M2M gains, but it would be marked by very high volatility because rates can go up, down, volatility would be very, very high. But the bucket which I just mentioned between say 3 to 5 years would have a lower volatility and higher return compared to the very short end. So depending upon the risk profile of the investor, he can create portfolios.
Pradeep, I guess the next question is directed towards you. It is from Aarti. So she is not comfortable currently with the gilt at this level, and she wants to wait further for market correction. So why do you think that it is good time for gilt NFO?
So I think, trying to time the market perfectly, whether it's in equity or in debt, is a futile exercise, right? You keep, waiting for that perfect opportunity. You will realize it only after the opportunity has passed you. But for reasons which Parijat explained earlier, we believe that, now is a good time. Now, whether this is the best time, we don't know. And who knows? after a few months, you may realize that this was the best time. So, that perfect opportunity is not going to come and announce itself. You need to make the assessment whether this is a good enough time with a 3-year plus horizon. And for investors who have a 3-year view, we believe there is a very compelling value proposition right now in terms of good accruals, possibility of mark-to-market gains, and finally, and very importantly, the taxation benefits.
So Pradeep, she also wants to understand that how can MFD sell this product confidently? She is of the view that yield curve may cross 8% in the near term. So in this scenario,
it may cross 8% very well, as we explained earlier. Nobody can say it won't, although we believe possibilities are probably a little low. But the question is, can it sustain at that level?
Mm-hmm.
Right? So if you are a 3-year investor, somebody with a 3-year horizon, if rates from say 7.45, say for argument's sake, they go to 8%, but after that, if they fall to say 7 or 6.5, you're still fine. Okay. Important thing is start with a proper asset allocation plan. Have a definite horizon in mind. See, if you don't really have a 3-year horizon, if you have only a 6-month horizon, this may not be a right product. But for somebody who can afford to wait for 3 years, we believe even if there is a spike in interest rates briefly in between, they would still stand to gain overall.
Okay. So Pradeep, so this is my question. And I think Pradeep and Parijat, I want both of your view in this. So many MFD find it difficult to understand debt products. So how can they make debt fund narrative simpler for their clients?
Okay, Parijat.
I'll see, Nishant, the normal perspective is that a debt fund or is just like one FD, and there could not be any loss. So that is where people believe, or it is how it is sold in the market. It is true that if you hold for a period of time, you will not get negative returns. What happens is that because it is valued on a day-to-day basis based upon the interest rate movement, right, you see a notional loss on the portfolio because it is being marked to market, just like your equities happen. Because equity prices are very simpler to see. In debt market, the yields are not easy to, or the rates are not easy to visualize. However, if you wait for 3 years, what happens? Your accrual notional loss which is there on the portfolio. So I will take one example of FD. If you have taken one FD a year back at 5%, if I value today, you are in a loss, notional loss. But because you don't see that, that's why you believe that debt funds are risky. There is negative return. If you exit when you see the negative return, yes, it would be negative. But you hold on for the period which you have thought to invest, like 3 years, it will still be much higher than your FD returns. So that is how it needs to be explained to investors, that do not go by the volatility that you see, because accruals are not going to become zero. They are going to coming back, but right, they come back over a period of time.
Right.
So this is how it has to be explained.
Pradeep, your take on this?
Yeah, I absolutely agree with Parijat. See, the problem with mutual funds, and this is our positive side also, is that we keep declaring value every day, and then that forces people to keep looking at the value, right? And if you take that example which Parijat gave, 1 year back, if you had invested say 10 lakh rupees in an FD carrying 5% interest rate, and today if you try to sell it, hypothetically, you're not going to get 10 lakhs. You will get something significantly less than that. Just because you're not trying to sell, or there is nobody who's going to buy, it's not a transferable instrument. You don't realize that you are making a loss. So I think important thing from an investor's point of view is to have the expectations right, and for the distributor also to make sure that the investor understands what she or he is getting into. So which is why we repeatedly say that, this product is good for people with a 3-year horizon. If you have only a 1-year horizon, there are probably more suitable products. But for someone with a 3-year horizon, there is a very compelling value proposition. And that is what needs to be kept in mind. See, that is precisely why there are different categories of mutual funds, because the needs of investors vary, the risk profiles vary. So, yeah, this kind of funds, gilt funds, will be more volatile compared to, say, an ultra short-term fund or a liquid fund even, right? But, that also comes with the probability of getting higher returns if you wait for that 3 years, particularly with the benefit of capital gains tax indexation.
Right. So,
Nishant, just to add,
yes,
see, you take it as a 1100-day FD. You see that, in banks, there are, advertisement that 1100-day FD at 7.
right.
You don't go and keep looking at the value every day.
Right.
So that's where I say investors that take it as a 1100-day FD, which becomes slightly more than 3 years. So you get capital gains benefit, taxation benefit, and don't keep looking at the value on a day-to-day basis, because this is how it is positioned, the product.
Right. So Pradeep, as you rightly mentioned that there are many categories of debt fund. In fact, there are 16 categories of debt funds. And so according to you, which are the 2-3 schemes that can address most of my needs, financial needs and aspirations?
Well, I would say for your real short-term needs, a liquid fund would be quite appropriate. Carrying a very low level of risk, but still giving high liquidity and decent amount of returns, I would say. And for people with something like a 3-year horizon, a gilt fund at this stage would be a good option. 1 year back, we might not have held that view. But currently, a gilt fund would fill in an important need for most investors. But the other product which people can look at is a corporate bond fund. If you have a 2 to 3 year horizon, you want respectable accruals from good quality securities from a credit point of view with relatively low volatility. A corporate bond fund also would be a product that people can look at. So today, I would say, given the scenario, these 3 products could meet a large part of investors' needs. Not everything, but a large part of investors' needs can be met with this.
Pari, you would like to add something to this?
No, Pradeep rightly highlighted, because based on your risk profile, one can look at liquid fund for a short-term needs, because see, the liquid fund returns are also upwards of 5% today compared to your savings account.
Right.
So, it has become very, very attractive. And gilt fund, you have safety in credit, and, returns are there. And if you are, and corporate bond fund is what we call is a fund for all seasons.
Right. Absolutely.
Yeah.
So our audience, Nutan, wants to understand where to invest in debt. In the current market scenario, which funds to consider?
Obviously, gilt fund looks attractive from both the extremely lower risk from credit and high returns for 3-year plus kind of horizon. And corporate bond fund continues to remain attractive because yields have gone up. And as we believe that rate cycle could start to turn around, maybe in the 4th quarter of this financial year. So these 2 products are very, very rightly placed at this juncture.
And Sneha wants to understand whether short duration funds better fit in this current scenario.
Short duration funds, Nishant, as I mentioned, RBI is expected to continue hiking the policy rates. So obviously the short end of the curve would get impacted. It could move up. So there could be, in the interim, could be MTM losses, and your accruals are also low there. So at this juncture, Maybe after RBI has done with all his rate hikes, one can look at it. But at this juncture, slightly higher on the yield curve makes more sense.
Okay. So Pradeep, many investors are many distributors still wants to know why not target maturity, why gilt?
No, I would again, reiterate that it is not a question of one or the other. It is a question of, what type of investor you have, right? The main, thing you need to keep in mind while going for a target maturity fund is the liquidity, underlying liquidity in an open-ended fund. And they might have been a better fit when the rates were a little lower. And at today's accrual levels, today's yield levels, we would definitely think that gilt fund is a better value proposition.
Okay. So Pradeep, Abhilash wants to understand how can he position debt funds to their clients?
Well, I think it's a matter of asset allocation. Okay, again, there is no one size fits all kind of formula here, right? You need to understand what is the profile of the investor, risk profile, and what kind of time frame they have. Now, typically, we would say anything that is kept for about 3 years or less should ideally be allocated to debt funds, right? Because we don't recommend people look at equity with ideally not less than 5-year view, but a very bare minimum of 3-year view, right? So that could be used as a thumb rule. So see how much of the funds for an investor can be allocated for, say, less than 3 years, and what is there for, say, more than 3 years or more than 5 years, and use that up to 3-year part for different types of debt funds.
So Pari, I mean tax-free bond versus gilt. So a question has come.
See, tax-free bonds, yes, they tend to be what I would say called illiquid in the sense that I may buy, but when I want to exit, it becomes difficult. So, and these are generally longer tenor. So for say 10 years. So if I buy as an individual a tax-free bond, I have to sit through the entire 10 years. And yes, returns are comparable, but the liquidity is an issue because then selling or getting out of that when you need money is a challenge. But in the gilt fund, this challenge is taken care of. There is liquidity, you can enter, exit, invest wherever you wish, and returns are comparable. So if you look at these aspects of the risk return, gilt fund would be definitely better today, I would say. Not always, but today, yes.
So Pradeep, there are many gilt funds in the markets currently. Then why MFD should consider Union Gilt Fund for their clients?
So one is that from our perspective, we are launching this product when we believe there is a compelling value proposition for the investor. So the idea is not just to come out with one more product because we had ample opportunities to launch this kind of product earlier. So we always believe in offering products at times when it's suitable for investors and there is really a good value proposition. The second thing people need to keep in mind is where is this coming from? I mean, why are we able to say there is a good value proposition and the time may be good, etc.? It is all driven by a very strong fundamental process that we follow within the company, right? The kind of process that we have for credit assessment, for forecasting interest rates. We have a proprietary model, and we look at a large number, I think about 32 high frequency indicators while forecasting interest rates. So the highly process driven approach is what makes us unique in the market on the fixed income as well as on equity. And I think for those who are looking for a good balance of risk and reward, it would make a lot of sense, because we are not a fund house which does anything adventurous or flashy. So idea is to provide a good value to investors in terms of risk reward ratio. So which is why, if you remember, the entire last year, we refrained from launching NFOs,
Right.
because we didn't believe the timing was right. Except a money market fund, which we thought was good value, we didn't launch NFOs because we didn't believe in that at that stage as a fund house. But now we believe there is something of compelling value to offer to investors, and that's why we are offering this product. So that will be our endeavor, and I think for people who like that kind of approach, that kind of philosophy, they should definitely look at Union Guild Fund. Obviously, we'll never recommend that you put all your money in Union Fund, but I think we have done enough to claim that certain allocation should be made to Union Guild Fund. So,
Pari, your take?
What Pradeep said is true. That because the timing that I highlighted, because yields are higher. In fact, they are much better than your small savings. The money you allocate into small savings, just like national savings certificate, it is on an accumulative basis. Similarly, if you wait for 3 years, the story is very compelling today to invest in Guild Fund with hardly any credit risk, because you are investing in sovereign paper, higher accrual, chances of MTM gains, and taxation benefit. So it is a very, very compelling story today to invest and lock in your returns at this point.
So since we already ran out of time, I'll ask just one question before wrapping up. So Pradeep, 2 key benefits of Guild Funds.
I would say low credit risk and good accruals.
Okay. So Parija, 2 unique things in Union Guild Funds.
Unique thing is it is a process driven, which we know that how and when the rates are going to turn around. We forecast interest rates based on our high frequency indicators, and being true to the level. So what I am telling you, you will get in your portfolio.
Great. So all the best to both of you for your new Union Guild Fund. And all right, so we have come to an end to this interesting session. Thank you so much, Pradeep and Pari, for such an insightful discussion today.
Thank you, Nishant.
Thank you, Nishant. Thank you, Pradeep.
Okay. And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.
We thank
you.
Audience.
Bye.
Thank you.
Bye.